Hello viewers, I'm Sanjeev Pandya welcoming you to another episode of the Tax Time. Your taxes matter. Slowly by slowly, tax season comes to an end, but there are still some information that you really need to know, and that's why we bring you this show to give you all the latest that you need to know when it comes to taxes. I am joined by Mr. Ajay Kumar of SAI CPA Services. Sir, welcome to the show.
Thank you, Sanjeevji.
How is your schedule going? Crazy, busy?
It's crazy busy. Yeah, those are the choice of words.
Exactly.
Crazy and busy.
Crazy and busy. But you take time out and to come to studio every week, so we really appreciate that.
Yes, you're very welcome.
Now, you're busy during this tax season. Tax season is going to be over very soon.
Yep.
Okay, April 15, things going to be really calm down.
Mm-hmm.
Now, as a taxpayer, the question comes to me as a taxpayer, what should they keep in mind after the tax season is over? That means your taxes are filed, whatever it is, you file the taxes, whether you're getting a refund or whether you're paying to Uncle Sam, it's all done.
Right.
What are the things to be careful after the tax season? So next year when you file your tax return, perhaps you can take advantage of certain things that you didn't take. You can take some deductions.
Absolutely.
And you can also be a little more organized and plan your taxes such a way that maybe your liability is not as high as it was this year.
Absolutely. So saving taxes is more about tax planning. There is no rocket science. There is nothing you can do to save taxes unless you plan it in advance. We get a lot of clients coming to us in February, March. What can I do to save taxes? And in a lot of cases, we end up telling them, you could have done this, you could have done that, but the year is already over.
It's too late.
It's too late.
Exactly.
It's already January, February.
Absolutely, yes.
So this episode is meant to provide the information for our viewers what they need to know now. It's April, but you have 6 months to plan. If you take care of these changes, you can make a substantial difference to your tax liability, especially under the new tax reform. What used to be deductible is not deductible. Viewers did not realize it. This is the first year when you file your taxes, you go to the accountant, the CPA, and the CPA tells you, oops, that's not deductible. Client entertainment, not deductible. Tax preparation fees, not deductible. Unreimbursed job expenses, not deductible. Locker fee, not deductible. Okay. You start asking, what is deductible?
What is deductible, exactly.
You tell me what is deductible so I can plan it right. This episode in April is meant to give you the information that you need to think about, you need to plan about in next 6 months to make a difference in your tax liability.
Absolutely. So now let's go with the individual and corporate tax filing deadlines.
Sure.
And then let's give our viewers a complete overview on that.
That's a great start. So the tax filing deadlines for S Corp and LLC was March 15th. For individual and C corporation, large corporation, is April 15th. For any reason, if you cannot file your taxes by the deadline, please consider filing the extension. You can file Form 4868, very easy to file. You can go on IRS website and do it yourself, or you can have an accountant do it for you. But if you file an extension, then the government, IRS and the state, cannot charge you the late filing penalty. Please understand though, the extension is for filing the taxes, not for making the payment. If you owe money to the government, you still need to pay it now. Otherwise, government will charge you late payment fee, along with the late filing fee. There are several different type of penalties in there. So if you cannot file your taxes by April 15th, please file an extension.
Okay, that's what we do know. I think one thing we got missed out on a partnership. Partnership tax return due on September 15th, right?
Well, partnership or multi-member LLC, their taxes are due by March 15th, unless they file an extension.
Okay.
If an extension is filed, then the taxes will be due on September 15th.
Okay, and what about state tax extensions?
State tax extension is due typically for most states when the federal extension is due. But in some cases, in some states, the state tax extension deadline can be different. So you need to really look at which state you need to file the taxes. In most cases, the extension deadline is the same deadline as the federal. For multi-member LLC, for partnership, the tax filing deadline is March 15th. Unless you file an extension, then you get 6 more months to file the taxes.
Okay, that's interesting. Now let's just talk about tax reforms.
Right.
Now this tax season is almost over. It's going to be over. For most of the people, it's already over because they filed their tax returns. Either they got the refund or they send a check out to Uncle Sam. Now let's just talk about tax reforms. Do you want to just touch base on tax reform matter?
Absolutely. Under the tax reform, a lot of people are realizing that they are not able to itemize their expenses. Donation is not as lucrative from the tax perspective anymore. So the standard deduction have been doubled up. For a married filing joint tax return, standard deduction is $24,000. For head of household, is $18,000. Well, if you combine the fact that your local tax, including the property taxes, are capped to $10,000, you don't have a lot of expenses over there that you can list to have itemized deduction over $24,000 unless you own a home and you have large mortgage interest. Mortgage interest is still deductible 100% if your mortgage principal amount is up to $750,000. So a lot of people are realizing that they are not able to file itemized deduction. Then they start questioning. Up until last year, a lot of people used to donate a lot of money during Christmas, lot of clothing, lot of old clothing, lot of items during Christmas time, just to get advantage of the taxes. Lot of people were donating car because they were thinking they will get some advantages on their tax return. And now when they realize that they are not able to itemize, they are only doing the standard deduction, those gifts, those donations are not counted. They are not giving the benefits that they were hoping for. Under the new tax reform, a lot of, as much as 90% people are using the standard deduction as opposed to itemized deduction.
But whatever that you've been donating, and if there is no tax advantage, that should not stop you from donating.
Absolutely.
Whatever you can donate,
that is true.
It comes to help of a needy person out there. So whatever you can whatever you can donate, you should donate. And when it comes to tax deduction, I know that's a completely different matter. So that is what we're discussing in this episode. We're going to take a short break. We'll be right back after this messages. Welcome back to the second segment of the Tax Time, Your Taxes Matter show. In this episode, we are talking about what after the tax season. Once your taxes are filed, it doesn't mean that you shouldn't worry about your taxes come next year, April 15, 2020 or January 1st, 2020 rather, right? There should be certain planning, there should be certain things that you should be keeping in mind in order to prepare for next year's taxes.
Great idea.
Before the break, Mr. Ajay Kumar of SAI CPA Services was explaining to us what needs to be done, what not need to be done. Tax reform that you started to talk about. Now in the tax reform, can you give us a little more information when it comes to medical expenses?
Right, absolutely.
And also some job related expenses.
Wonderful, I'll be happy to. So medical expenses used to be deducted over 7.5% of the AGI.
True.
Under the tax reform, it has been increased to 10%.
Okay.
So if somebody is making $100,000, their medical expenses over $10,000 are going to be deducted. If you spend $11,000, only $1,000 is deducted. So in this situation, when you know it's a large amount, then you need to couple it together. If you have 2 children, they both need the denture. Instead of doing it 1 year this year and one for the next year, you try to combine it in 1 year. So your total medical expenses can be combined in 1 year, and they become over 10% of the AGI.
That makes sense, right? Absolutely.
And as far as the job-related unreimbursed expenses are concerned, a lot of people were claiming home office expenses, their laptop expenses, their telephone expenses, in some cases even their travel expenses. All those expenses are not allowed, are not deductible under the new tax reform bill. This is where the planning kicks in. What can you do now? A lot of people were keeping logs. I had to go there, I had to come from there, I had to buy this uniform, I had to buy this laptop, I work from home every Friday, this is my exclusive workplace. All those things are not allowed if you have a W-2 job. So you have to plan it right, you have to plan it now.
Absolutely, that's very well said. Now let's talk about tax planning.
Sure.
Tax planning, as simple as it sounds,
Right.
but to plan for taxes for the following year, That's not really easy thing to do. So let's just highlight some of the points. Give us some bullet points that what
That's a
we
great
should
idea.
be doing it. Yes.
Absolutely, that's a great idea. So tax planning is more about understanding how it works. So the last tax bill, the last tax rules, they were there for 30 plus years. We had a new tax reform. A lot of things got changed. A lot of those deductions are not allowed anymore. There are some deductions that are still allowed. So you have to know what's allowed, what's not allowed. You have to plan it right, plan it accordingly, so you can claim the expenses that you should be allowed to claim. So staying with the job-related expenses, a lot of people have a W-2 job, and then they are trying to develop a business on the side, which sometimes is a hobby or sometimes is a real attempt to make money. And they were claiming some of those expenses against their job on Schedule A. Those expenses are not allowed anymore. So if you have a side business, you have an intent to make profit out of it, don't keep it as a hobby. Incorporate the business. Then you can put it on Schedule C, or you can have a separate tax return for it and claim all those expenses that you are spending to develop that business. So if you have an IT consulting job and you have say trying to develop an IT company, or you have a doctor's office, you see some patients on the side, whatever business you have, if you are trying to develop a business, incorporate it. So it's seen as for-profit business, then the expenses, you don't have to make money out of it. It doesn't really have to create profit. Even if you have invested money, all those expenses becomes tax deductible.
Interesting. Now, how does retirement savings account help in tax planning?
It's a great question. Retirement savings account is one of those things that's sacred. They haven't touched it, they haven't changed it, they have improved it actually. So you can contribute to your regular IRA if you want the tax deduction now. If you are in a high income tax bracket, you want the tax benefits now, then contribute to your regular IRA. You have the right to contribute up to $6,500 per person. Even if your spouse doesn't work, you can still contribute for your spouse. As long as you have earned income yourself, you can contribute for both of you. You can contribute to the Roth IRA if getting the tax benefit today is not important. So the growth on the Roth side is not taxable for you. You can contribute to your employer's 401k plan. There the limit is $19,000. If you are self-employed, you can contribute to the SEP plan. There the limits are $56,000, or it's 25% of your W-2 job if it's an S Corp, or 20% of your self-employed income on Schedule C or an LLC.
So with the tax planning, I think education planning also is very important.
Absolutely.
If somebody has grown children and they're going to be going to college in the next couple of years to come, how can they start planning for their education?
That's a great question, and I forgot to mention 529 plan or education plans is one area that has been improved. A lot of people are feeling everything is going down the hill. It was allowed, it's not allowed.
Yes.
This thing was allowed, this is not allowed anymore. 529 plan is actually one plan that has been improved under the new tax reform. Under the old rules, 529 deductions, 529 contributions were only allowed if you take the money out for an accredited university. After the high school, if your child is going to a university, only then you are allowed to use the money out of the 529 plan.
Okay.
Under the new tax reform bill, you can take the money out of the 529 plan for any purpose, for any school, any education,
school, any
vocational
technical school, any
religious
community
school,
college,
community college,
religious
religious
school also,
anything,
which is good because
which is very good.
Education is education.
Up to
it shouldn't be only
$10,000
limited to accredited universities.
Up to $10,000 per child,
Right.
you can take money out of your 529 plan at no tax consequences to you. You have to understand the contribution when you
Yes.
pay money to 529 plan, that's not deductible on your IRS 1040.
Okay. All right. Did we talk on rent versus buy in this tax planning?
Well, so rent versus buy, it's a great confusion. A lot of people feel rent is not deducted, rent is not deductible. A lot of people don't realize on the state of New Jersey, in a lot of states, for example, New Jersey, the rent is deductible on their state tax return. When people are talking about the rent is not deducted while the mortgage, property tax up to 10,000 or interest is deducted, they're talking about their federal return. So you have to really see the rent if you are able to deduct the rent on your state side.
Okay, very interesting. With that note, we're going to take a break, but when we come back, we got more on this after tax season, including IRS scams, how you should be very careful, and some of your questions coming up in the next segment. Please stay with us. Welcome back to the third segment of the Tax Time, Your Taxes Matter show. In this episode, we are talking about what to do after the tax season. Tax season almost comes to an end. When it's April 15th, we know that it's almost an end of tax season, but for people who file extension, that's not almost the end of it. Whoever decided to have April 15th the end of tax season, same time as a spring break from the school and colleges.
Yeah, I know. It's terrible.
Somebody planned it such a way that, I mean, it just doesn't make sense, but that's how it is. Anyway, so we do have, questions from our viewers,
Sure.
Mr. Ajay Kumar. And one is that if someone owes a lot of taxes, should they not file the extension?
Wow, yeah, that's a great question. And the question typically is, hey, if someone owes $10,000 and if they file the taxes now, they have to pay the money now. How about if they file the extension? Then they don't have to pay the money. That's the confusion.
Correct.
And as you were describing earlier, the extension is for filing the return, not for making the payment. If you owe money, you need to pay it today. You need to pay it now, sooner than later. Otherwise, IRS will charge you not just the late filing fee, but the late payment fee and the interest on that amount.
What's the normal interest on that?
Well, it depends. It changes, but it's about 5%.
It's about 5% for the whole year.
Yes.
Okay. And late payment fee is?
Late payment fee depends on how much you are paying, how late you are paying, and how much amount you owe. And if you haven't paid at least 90% of your total owed liability or 100% of your last year's tax liability, only then you end up paying the late payment fee.
Late payment fee. Okay, but it can be substantial.
It can be very, very high.
All right. So to answer this question is like you can't avoid paying $10,000 from April to October.
It's in your benefit to pay it now. Otherwise, the amount of additional fee that you'll be paying is not worth it.
Okay. Now, next question is very interesting question from one of our viewers, and nothing to take away from CPAs and professional accountants. Okay. The question is, where can someone call to get more information about their liability?
It's a great question. A lot of people get these calls, the scam calls, and a lot of these false calls. So people should know where can they call, and we'll list the numbers. 1-800-829-1040. That's IRS hotline for individual. 1-800-829-1040. If you have a question, if you are not sure about anything, if you owe some money, please call them directly. And then you can get complete profile for as many years as you want. You can understand what you owe, why you owe what you owe, and if everything looks clean, you can get some sort of documentation from them. You can get some sort of proof that you don't owe anything from them.
And that is actually a good thing to do, because in light of all these scams and IRS scams happening, right? It's a good idea to call IRS, and all you need to give is your social security number, name and address and everything, and they can figure out.
Absolutely, they will do the identity verification. It's very, very common during this time of the year to be getting a lot of letters. People just filed their taxes. They are still thinking about their taxes. They're expecting, quote unquote, a letter from IRS. So when they get a letter from IRS and talking about their tax return, they can relate to it because they just filed their taxes in the last few weeks. So if you have a letter like that, call this number, the number that we just provided, directly. Don't call the number listed on the letter. A lot of times these letters are fake. They make you call a number that they want you to call. So go on internet, go on Google, find out the IRS number and call that number directly instead of responding to that notice immediately.
Just a couple of weeks ago, Mr. Ajay Kumar, we did an entire episode on IRS phone scams, and most interesting thing is letter scam, because letter comes in the mail to your house, and it looks like IRS letter, but it's not.
It looks very close to the IRS letter.
Exactly. Anything else you like to add in this episode when it comes to IRS scams?
Well, the IRS scams are getting very, very creative. So not only they have the phone scam where somebody calls you, they try to threaten you, and then they give you a number. Then that number is already planned. They have their own person sitting on that number. It used to be the typical phone scam. Now it has been extended to the email scam. it has been extended to the lateral scam that we show to our viewers.
And the federal student tax scam also?
Absolutely. So a lot of times they are targeting the low earned people, low income people. A lot of these students, they have applied a lot of places for their tax benefit, for their tuition benefit, and they are targeting those people who cannot go to a CPA, and they're counting on a small amount of money. Hey, if you don't pay me $300 now, we'll do something bad. They are trying to threaten it. They will never ask for $30,000, because if they ask for $30,000, you will take the bill to an attorney, to a CPA, and you will not pay. So the typical liability in a fake letter is very, very small, and they're counting on to threaten you, so you can pay the money right away.
They go for the smaller the numbers but higher the volume.
Absolutely.
That's
this is how
they
the
do it.
scam works.
The scam is just unbelievable, and there's no way to stop them. I mean, the authorities and
I'm sure IRS is trying very hard to curb
I'm
it
telling
out.
IRS, police, they're all trying
Absolutely.
very hard, but it's very difficult. Now, last question we have for this episode, okay, what is one thing that someone can do when it comes to tax planning?
So the tax planning is more about understanding, learning, knowing what can be deducted, what cannot be deducted. A lot of times people will start with nifty spreadsheet with a fine system. Oh, this is how I'll track the mileage, this is how I'll track the donation, this is how I'll track the medical expenses. And over the years they lose steam. They will stop following the spreadsheet, they will stop tracking the whole expenses. So I call it a shoebox approach. You have an expense, you put it on a particular credit card. Make this credit card only for the business expense. You have a receipt, put it somewhere. Don't have to record it now. But if you can find this receipt when you want to find it, that's enough. So create a shoebox, put all the receipts in there. If you have a small business, get a credit card over there, just for that business only. Any expense that you wouldn't have had if you did not have this business, that's a business expense. You take a separate credit card, put it all there. So it's all about planning, understanding, knowing what can be deducted, what cannot be deducted, and you plan accordingly.
Very good. That's a very good answer that you gave, because that's coming from CPA and accountant Mr. Ajay Kumar of SAI CPA Services. My version of answer to that question is that what's the one thing you can do for tax planning? Don't work, so you don't have to pay taxes. You know. Anyway, with that note, we come to an end of this episode, and this episode was titled "After the Tax Season." To me, after the tax season, you don't need to do anything. Just go to Disneyland, Disney World, and take a vacation.
If you have a large refund, that's a good idea.
Okay. As a CPA, do you take time off right after the tax season? Do you go on a long vacation?
We try very hard to take some time off, because the tax season is always tough.
Yes.
But there are a lot of things that we push out that we'll do after the tax season.
So after October 15th, after October 15th, you basically take it a little easy.
Absolutely. It takes a couple of weeks to catch up first.
Yeah, very nice. Anyway, with that note, I'd like to thank Mr. Ajay Kumar of SAI CPA Services for this wonderful series of the Tax Time, Your Taxes Matter show. He's been extremely helpful. He's been a great guide and great mentor. I guess you have given us a lot of hints, and our viewers have benefited a lot. So we thank you for so much. Thank you for your time. Thank you for sharing your knowledge and everything.
Absolutely, it's my pleasure. Thank you very much.
Thank you so very much. With that note, we come to an end of this episode. Tax Time, Your Taxes Matter. Tax season comes to an end. Hope you have had a wonderful tax season. Hope you got some money, and if you had to pay some money to IRS, do better planning next year, so that way you can get a refund. And there are many ways to get a refund. That's why you need to have a very professional accountant to do your taxes. With that note, I am Sanjeev Pandya, wishing you all long and happy tax-free season. Thank you for watching the show. So long.